Hello, everyone. Aaron Gaines here with Landmark Financial Services, coming to you today with another video on student loans, specifically another case study on public service loan forgiveness, or PSLF. So in today's video, I want to go over some similar loan data as the previous week. However, I did make a few changes here, which is going to drastically change how this person either signs up for the income-driven repayment plans or files their taxes specifically. So let's look at this case study. So Aaron is, let's say, a recent graduate from UVM with roughly $26,000 of federal student loans. His income is roughly $40,000, and now the important thing here is that he works for a local nonprofit and he is eligible for public service loan forgiveness. He is 25 years old. He is married and he has one child. Okay. His spouse currently is earning $60,000. However, she does not have any student loans. Okay, so that's kind of the basic information for this case study. Now, the big thing I want to point out here that is a little different from the video from last week is that there are 3 years of undergraduate and then one graduate degree program. Maybe they ended up going for a semester, they didn't like it, they ended up dropping out. Who knows? This is just an example that I'd created, but it's important to know that if you remember under certain income-driven repayment plans and you're not going for public service loan forgiveness, that will potentially add extra time on that forgiveness. So for example, under the SAVE plan, if you are on an income-driven repayment plan and you are not eligible for PSLF, and you have graduate loans, instead of a 20-year repayment, it is actually 25 years. So just kind of a small little quirk, but it is important for you guys to understand that. Now, another thing that is important to understand is the fact that one of these loans is actually not a direct loan, it's a FEL loan, which basically means that in order for Aaron, this person, to sign up for any of the income-driven repayment plans, they may have to consolidate that loan in order to sign up for the plan that they want to. The only plan that Aaron is currently eligible for would be one of the income-based repayment plans, but we'll talk about that in a second. Okay, so but anyways, in this case study, I came up with a few questions that I thought would be interesting, and to see if whether or not maybe you guys could answer these. Okay, so the first question is, what income-driven repayment plan is Aaron currently eligible to sign up for? Well, I already just kind of mentioned that, but that is the old income-based repayment plan, and that is because that is the only plan that allows for you to sign up for an income-driven repayment plan that has direct and non-direct loans. Okay. And then the second question is, Aaron currently eligible for PSLF or public service loan forgiveness? The third question, what plan will allow Aaron the lowest monthly payment if he were to file a married filing joint tax status? What would be the difference between Aaron's 10-year standard payment versus the IDR plan with the lowest monthly payment? And 5, what would Aaron's lowest monthly payment be if he filed married filing separately? Okay, so I kind of want to go back to the first question a little bit and say, okay, so what income-driven repayment plan is Aaron eligible to sign up for? Well, he's technically only eligible for the old income-based repayment plan, like I said, and it's specifically because of this FEL loan. If this was a direct loan, then he could sign up for, based off of the dates here, he could sign up for any of the income-driven repayment plans. Second question, is Aaron currently eligible for PSLF? Well, actually, no, he is not. And the reason is, it all stems back to this FEL loan. Now, this FEL loan is going to hinder his ability to sign up for PSLF. They just won't let him do it. And so in order to do that, he will need to consolidate that loan to get all of these loans into a direct consolidated loan. And so what does that look like? Well, so I basically down here, I just copied and pasted all of these. And I showed you what the loan servicers would do and how they would end up calculating that consolidated loan. Okay, so it's important to understand that all of this is basically just copied and basically all of this is copied and pasted. However, I've added these two different columns here, percentage of total owed and the percentage of weighted average. And so what am I doing here? I'm basically calculating for this loan, what is the percentage compared to the total loans outstanding? Well, for this loan, it is 28% of the entire balance, and you calculate that for each other loan. And now we're going to calculate the interest, the weighted average interest based off of all of these other loans. So same way, this is calculated by taking the interest rate and multiplying it by that percentage. It gives you an average of 1.208. And then you add those all up to get a 4.201%. Now, the important thing for you guys to understand, this is extremely important, is that when you consolidate these loans into a direct consolidated loan, the loan servicers are automatically going to round to the nearest eighth. And so because your interest rate is 4.201, it is now going to be rounded to 4.250. Okay, so that's very important to understand, especially since, well, one of your loans was at a 3.51% interest rate. So very, very important to understand that concept. And so this is what it would look like. It would just, you would take all of these loans and it would look just like this. The current principal, and then with this new interest rate. Okay. Now, like I said, Aaron is not currently eligible for public service loan forgiveness, but if he consolidated and did this, he could then sign up for any of these plans. Okay. So very, very important to understand. Now let's go back to the third question. What plan would allow Aaron the lowest monthly payment if he were to file married filing jointly? Well, remember how Aaron is making $40,000 and his spouse is making $60,000, and so if we were filing jointly, their income would be $100,000. Well, let's calculate their discretionary income. Well, remember how I said that for an individual, they get to use the Human Health Poverty Guideline, the HHS Poverty Guideline. For 2024, it is $14,580. And for each additional person in the household, you get to add $5,140. And then because it's the ICR plan, we're going to multiply that by 1. So it is 100,000 minus all of this, which gives us our discretionary income of $75,140. And because it's the income contingent repayment plan, that is 20% of discretionary income of this number. So it gives you an annual payment of this. Divide that by 12, that's your monthly payment. For the old income-based repayment, it's the exact same thing, except the multiplier on this instead of 1 is 1.5, which again will lower the discretionary income. And now again, the multiplier on this is instead of 20% of discretionary, it is 15% of discretionary income, giving you an annual payment of $9,406. Divide that by 12 is $783. And then again, with the new income-based repayment and the pay-as-you-earn, these calculations are identical, the exact same calculation multiplied by 1.5, but instead of 1.5 as the multiplier, it is 10% of discretionary income, giving you $522 for the monthly payment for both those plans. And lastly, the SAVE plan, $100,000. Well, this multiplier is 225% or 2.25 of this 100,000, giving you discretionary income of $44,000 compared to in the ICR $75,000. So very, very important to understand the difference. And then again, this is 10% of discretionary income. That's actually going to change in, I believe, July. That's going to change to 5%. So the SAVE plan is going to have an even better calculation in the near future. However, that monthly payment is $367. And so if we were to compare that to Aaron's 10-year standard payment, remember that amortization calculator that I pulled up last week? Well, if you were to do that for a 10-year payment on $26,444, which is the total balance of the loans, then your monthly payment on that would actually be $270 compared to $367. So in this example, it actually would not be beneficial for Aaron to sign up for an income-driven repayment plan or to sign up for PSLF because he will pay off those loans in less than 10 years. He'll have a lower payment, so it just wouldn't really make sense to do so. And so let's go to the fourth question. What would be the difference between Aaron's 10-year standard repayment versus his current payment? Well, if you take this minus the $270, that's almost a $100 difference. So there's really no reason that you would actually sign up for this income-driven repayment plan if you were filing married filing joint. However, if we're we were to look at number 5, what would Aaron's lowest monthly payment be if he filed separately? Well, instead of $100,000 of income, he's now got 40,000. Okay, and now, before I even go into this, what I do want to kind of, as like a disclaimer or just mention is, if you are going to be doing anything as far as like, with tax strategies, you should consult a CPA or an EA, your tax professional, before you make any of these decisions, because, you need some actual expert guidance. However, if you understand these concepts, you can go to them with an idea of a possibility or of what you're thinking, and they can help you with that. Okay, so anyways, in this part of the plan, let's say $40,000. Well, you can see that the discretionary income on all of these are drastically different. Drastically. Okay, and so for this one, before we even go into this, the one caveat by filing separately is that all of these plans are still eligible to include your spouse and your child in that HHS poverty guideline calculation, except for the SAVE plan, and I'll show you that right here in a second. So notice how in this calculation you still get to add the 14,580 for yourself, and then the 5,140 for both you for the spouse and the child. For the SAVE plan, you only get to do it for the child, not for your spouse. Okay. But anyways, these calculations are identical to the way that these are calculated. But what I think is brilliant here is the fact that under the SAVE plan, if you were to file married filing separately, this negative number basically means that your monthly student loan payment would actually have been 0. And that's basically because the calculation here on discretionary income says that you, with all those deductions, you are actually, you basically had 44,370 of deductions, and so your discretionary income is 0. Okay, so that's huge. So in this example, Aaron's monthly student loan payment would be $0 versus Aaron's 10-year standard payment of $270.25. So I hope some bells are kind of going off in your head that, you could potentially save some serious money if you are eligible for these types of plans, and if you are an eligible public service loan employer or employee. You know what I mean? I think it's extremely important for you to understand this. But specifically in this case, you would want to reach out to your tax professional and weigh the benefits, the pros and the cons of doing this. Because obviously, if you file separately, you are definitely leaving advantages of filing jointly off the table. Okay, so you would definitely want to check that. But anyways, guys, this was the case study for this week. Next week we will most likely have another case study, and so I look forward to the next video, and we'll see you then.